Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Thanks for joining us. Let's get across what happened overnight. Global equities making tentative gains despite oil prices rising further as President Trump reiterated threats that the US would destroy Iran's energy plants and oil wells if it does not open the Strait of Hormuz. So US stocks ended mostly lower, with all three of Wall Street's major indices beginning the session higher following heavy losses at the end of last week. Investors were buoyed by comments from Fed Chair Jerome Powell, who said long-term inflation expectations appear to be holding despite current energy shock. Among the mega-cap tech stocks, they were mixed, with Microsoft and Meta managing to finish in the green, while Palo Alto Networks, ServiceNow and CrowdStrike were among the best performers. Shares of US energy companies were mostly higher, tracking crude prices, and aluminium producers jumped as alumina prices climbed on prolonged supply disruption fears amid the Middle East war, with aluminium prices surging to a 4-week high. And US asset managers rose on new guidelines for retirement assets. Well, thousands of US Army paratroopers have arrived in the Middle East as President Trump warned Iran that the US would destroy its energy infrastructure if it does not open the Strait of Hormuz. The US President has also threatened to attack the desalination plants that supply clean water in Iran. Iran, meanwhile, has said it had received US peace proposals via intermediaries, with the Iranian Foreign Ministry describing the proposals as unrealistic, illogical and excessive. Well, the White House says President Trump is considering asking Arab nations to pay for the cost of the war, with his administration requesting an additional $200 billion in funding for the war from Congress. And Federal Reserve Chair Jerome Powell has said the US Central Bank can wait to see how the war affects the economy and inflation, saying there's sort of downside risk to the labour market, which suggests keep rates low, and there's upside risk to inflation, which suggests maybe don't keep rates low. You've got tension between the two objectives. Well, bond yields fell sharply as Jerome Powell reinforced a wait-and-see stance. The US 2-year was down to 3.81%, the 10-year down to 4.32%. Australian 3-year government bond yields fell to 4.71%, the 10-year is at 5.05%. The US dollar index was up around 3% on the day. The Aussie has weakened further to be at 68.5 US cents. Oil prices have continued their ascent, with Brent heading for a record monthly rise, while US crude futures settled above $100 a barrel for the first time since 2022. Brent futures settling just shy of $113 a barrel, having earlier climbed more than $4 to $117. Gold rose for a second straight session as safe haven demand picked up. Spot gold around 0.5% higher at around $4,500 US. Copper was little changed. Iron ore up to $111 US a ton, and Bitcoin is trading at around $66,500 US. Let's get across those market moves now. Steve Sosnick is the Chief Market Strategist at Interactive Brokers. He joins us again now. Steve, welcome back. So, first session of the week just gone for you. I'm interested to know, you've said this is actually the first down Monday since the start of the war.
Yeah, that's one. First of all, good morning, Andrew. That's one of the crazier things that's been going on is actually, the markets had a case of the Mondays, but I mean that in the positive sense. This was in fact the first down day since the war started. If you remember, we actually S&P actually ended up on the Monday after hostilities started, and this makes only the second Monday in 2026 that we've ended lower on the S&P 500. There have been two Tuesdays, one up, one down because of market holidays, but still, we've generally started the week on a very positive note. Interestingly, though, we've ended the weeks typically on a pretty lousy note. We've basically only had three up weeks over the course of 2026. The first one was sort of a half a week because it was January 2nd was Friday, but basically we really have not seen a lot of positivity. Even as it seemed like we were in the midst of a pretty good year, a lot of the individual weeks were lower. So there's really been nothing so far to change that, and it would, obviously, we just started the week today, but it's a fascinating trend to me that we start with positivity and sort of start with a bang, end with a whimper, basically.
We'll see. Obviously, markets continue to react to those headlines out of the Middle East. In fact, we had two streams of commentary for the market to interpret. One from the president, that was pretty hawkish, wasn't it? Obviously, reiterating his threat against that energy infrastructure in Iran if they don't reopen the Strait of Hormuz. And then you had Jerome Powell speak as well, which sort of calmed the market to a degree, didn't it?
Yeah, I mean, at this point, I think people people are not really reacting to the president's rhetoric so much anymore. I mean, because today was basically literally carrot and stick at the same time. Either come to the table or we're gonna bomb you. Whereas the ceasefire news, last week's Monday ceasefire news was greeted reasonably well, although we failed to break above the 200-day moving average. Thursday afternoon's ceasefire extension was, basically ignored and sort of became almost a catalyst for the selling on Friday. So I think the market, it had been rallying pretty much since it opened, since the futures opened overnight. So you saw us open much lower from a pre-market futures point of view, and then end off the lows. And then by the time U.S. traders woke up, they just kept buying. And then the president put out his announcement, and there was a bit of a spike. But that evaporated very, very quickly. Within minutes after the open, we went from about 1% up to just barely higher. Then Powell spoke, and I paid close attention because literally he bumped me off a network appearance in the U.S. So I was sitting there waiting for him to finish, and he didn't. But basically, so I was paying very close attention. And you mentioned the push-pull, which has been something we've discussed for some time between weaker labor and inflationary pressures. But he seemed to be somewhat dismissive of the inflationary pressures, and markets did take that pretty well. Although stocks ended up fading, the bond market, as you noted, kept most of its gains. We were basically 8 basis points higher across the curve. It was the second day in a row where 2-year yields rallied, but that actually was part of the negativity that persisted on Friday, because it was really the first time since this all started that we saw a real flight to safety bid in shorter term fixed income. That's what we saw on Friday. Sort of, a little bit, a certain number of people throwing in the towel about this quick resolution and snapback rally in favor of sort of a more traditional risk off type of approach. Today, though, the move in bonds, I think, was very much almost across the curve, a parallel shift across the curve. And that was the result of markets being reasonably happy with what Powell had to say, although we do have to remember that his term is coming to an end rather soon. So it's nice to hear it from him, but the lasting effects may or may not be meaningful.
Well, nonetheless, Steve, obviously the market there has aggressively repriced the US rate outlook, potentially taking cuts off the table and even contemplating rate hikes. Certainly we've seen that in other central banks, including our own here in the Reserve Bank. But obviously those higher inflation costs are spurred by energy at the moment. What is the prospect then, perhaps, that there will be no more interest rate cuts? And once again, I guess you could say that does come down to the next head of the Federal Reserve, doesn't it?
Yeah, to some extent, Kevin Warsh is a bit of a mystery because he spent most of his he has been a Fed governor before, and he spent most of that term being quite hawkish. And now, to get nominated, he certainly took a much more dovish tone. So we'll see which Kevin Warsh it is. But again, when it comes to voting at the FOMC, he's first among equals. He's one of several votes. So as we see, let's say with Dr. Myron, who also spoke today and continues to advocate for lower rates, he may or may not be an outlier. We don't know how well he's going to be able to sway the rest of the committee. Plus, we still don't really know the timing because although there was some news reports today that the first set of hearings for his nomination will begin in April. Until or unless the court case against Jerome Powell is dropped, Senator Tillis, who's a powerful member of the Senate Banking Committee, promises to vote against it until that lawsuit is dropped. So uh, criminal hearing, I should say. So there's a lot of moving parts here, but the bottom line is right now, yeah, we went from having priced in two rate cuts plus a 50% chance of a third rate cut to basically a modest percentage of priced in for a hike. We'd gotten up to about a 50% chance of a hike at one point last week. We're now down to about 10 or 12% chance of a hike. We know that you guys are trendsetters through the RBA.
Yeah.
In the U.S., I don't think people are hoping to follow that trend, but it seems much more of a possibility if this conflict persists and continues to affect supply chains, not only for energy but for fertilizer and for helium.
Meanwhile, of course, obviously back to the equity markets, Steve, the Dow, the Nasdaq, both in correction territory now. Do you see any buying opportunity there? Have you witnessed any sort of buying the dip mentality at the moment?
We've seen customers continue to buy the dip. Remember, part of I forgot to silence my phone. Sorry. We've seen customers continually trying to buy dips. Remember, this has been something that's been ingrained for the better part of the last few years, where every dip has seemed to be a buying opportunity, and with the exception of a few months in 2022 and the brief post-COVID, collapse, we really have had buying opportunities. The post-COVID collapse was quick. 2022 was a bit more of a prolonged, traditional sell-off that lasted a good part of the year. And people remember what happened last April when the president reversed course and we had sort of a 9% rally. And, they really, the expression is you don't want your face ripped off. And I think that's what we see here in terms of there's a persistent bid for upside calls in the S&P 500 from people who remember that rally. And I think that's why we actually hadn't reacted worse so far, was because this FOMO, this fear of missing out, this thought that a rally was going to come and take us right back upward. And I think the longer we go without it, the harder it is to achieve. Not just because psychology is not particularly healthy, right? Certainly much less healthy than it was before, but also because it's hard to imagine, oil prices going right back to where they were before. It's hard to imagine a lot of these supply disruptions fixing themselves. When I look at crude oil futures for delivery out a year from now, yes, we're in steep backwardation. So they're much lower than meaning the 1 year out futures are much lower than the current price, but they're still about $15 above where the market was pricing them in before the conflict. So it's hard to imagine this thing just unravels in the same sort of way that Liberation Day did, where it was relatively simple for the president to change his mind on some tariffs that had not yet been implemented and that were going to be done by executive order anyway.
Yep.
It's easy to change opinions on that one and change course. It's not so easy to do this here with the various moving parts that are in play in this conflict.
Steve, always great to get your analysis. Thanks for joining us from Interactive Brokers.
My pleasure as always, Andrew. Talk soon.
Quick check of where we're likely to open. SPY futures there are in positive territory, just over 0.1%. Stay with us. The open is imminent.